Good day, students. Welcome back to the class. We are almost ending this subject now, and we had discussed about derivatives in our previous lecture. I shall be taking a little bit more time on derivatives this time because this is something new for you to understand. We've studied most of the other subjects in one way or the other, but derivatives is something new that you should all be focusing on, because this is the new thing that's going to help you in your careers and your professionalism as well. So as the name can be interpreted, derivatives is from the word derived. You derived a financial asset from an underlying asset, which means it has got the values based on another asset. An underlying asset. There has to be an asset on which you can make a derivative. So, we must understand that these are new financial products on which our financial world is now focusing more on. More words like derivatives and commodities instead of capital markets or futures are going to be two different things now. But derivatives is something for the future and is now being looked at as a serious way of really making good progress in making monies. The reason, the rationale that we had derivatives was very early in the United States of America, the need was there to protect farmers, to protect agriculturists, and to protect their products, so that way they would be able to get a better return on their products. So the first organized derivatives exchange in the USA was developed to protect farmers and their product, to eliminate or reduce the risk of price variability. So that was the rationale that we had a derivative exchange in the USA, to eliminate or reduce price risk. Because future is unobservable, because the future cannot be observed, there was difficulty in understanding how the people are going to be comfortable with the vagaries of uncertainties in the future. Now, there is actually no universally satisfactory answer to the question of what really a derivative is, but generally speaking, we must understand that it is almost used as a different way of trying to tell people that this is a way to make a loss. Anything that gives you a loss is a derivative, but that is not quite true. It is definitely a product that you can use to your advantage, or the product could use you to its advantage, which means you could have a negative and a positive aspect. So it's a dread word that people realize, or maybe anything that will give you a big loss. That's not true. Derivative is actually a wonderful product that has been created in the past 2 decades, in which you can actually make more progress as far as investments are concerned. Having said that, it would not be fair if I didn't warn you that anything to do with investments, anything to do with real estate investments or financial product investments will have its own downsides as well. The futures and options markets are very useful, perhaps even essential parts of our financial system. These are now going to be taken more seriously as other products of the financial world. Futures, options markets have a long history of being misunderstood. Why are they being misunderstood is probably because of the fact they're actually not understood at all. It's easy to put the blame on something which you do not understand properly and will not be willing to learn about it properly. Derivative markets are the products having derivatives which are exchange traded. The contracts are standard and there is virtually no credit risk. The reason is that they're on the exchange. And obviously, when things are on an exchange, there has to be some sort of sensibility and responsibility by the exchange as well. Traditionally, The exchanges have used, they still do in several places, the outcry method, the open outcry system. We had this here locally in our country as well until we transformed into the computerization of our exchanges, but increasingly other places are also now switching over to electronic trading. So there is now sadness as far as I am concerned with the traditional open outcry methods not being available, but you have to give way to modernism and go for the electronic trading now. Another way that you can deal in the derivatives market is by dealing it over the counter, the OTC market. This is purely computer and telephone network linked to dealers, institutions, financial corporations, and fund managers. But the downside is that contracts being done on the over-the-counter market has some amount of credit risk related to it. Since exchanges are not involved, it's between two people or two institutions, the probability just might be there that there could be a credit risk. Remember, when we were talking about risk, we understood that we had to focus on certain types of risk, and we could not avoid these risks altogether. Now, one of the most important derivative assets is the futures contract, and alongside is the options contracts. These aren't the only two contracts in the derivatives market, but these are two more popularly used, and we have two other products which I'll mention just right now. So, the derivatives in the options and the futures markets are not the same, but some are inherently speculative, while some are very conservative. It is how you shall be applying the derivative assets or using the derivative assets to your advantage. Make it more speculative or make it more conservative will all depend how you understand the derivatives. So, students, please understand that derivatives is not a dread word. It is not something that cannot be understood properly. I just mentioned two of the more popular products were futures and options. But we mustn't forget two other products, the forwards and swaps in the types of derivatives. So we actually have four major categories of products in the derivatives market. But now, traditionally speaking, we used to have forwards very popularly, but now that has been overtaken by the futures market. When looking at the futures market, we must understand that a futures contract is a promise. It is a contract that you must understand is about the future, and you made a promise. So, the initial seller of the contract promises to deliver quantity of a standardized commodity. The focus is on standardized. There has to be a benchmark. So, the initial seller promises to deliver a standardized quantity to a designated delivery point during a certain delivery month. The other party of the trade then promises to pay a predetermined amount for the price of the goods. The person who promises to sell is going short. The person who's promising to buy is going long. So time is fixed, the price is fixed, quantity is fixed. Futures contracts deal with transactions that will be made in the future. Futures contracts would once again, make it clear, be an agreement to buy or sell in the futures, just like a futures or a forwards contract, but a little bit difference between a future and a forward contract. Futures contracts involve a promise to exchange a product for cash by a set delivery date. And we have just discussed that futures are traded on exchanges. So then, now this should be clear, that futures are traded on the exchange. Futures are about the future promises, about certain products at a certain time, at a specific price, in a certain quantity. But futures are different from options. You remember how different they are from the options. Both being derivatives, both being parts, the difference is the buyer of an option can abandon, please focus on the word abandon. The buyer of an option can abandon the option if he or she desires so. The buyer of a futures contract, on the other hand, cannot abandon the contract. He has to go all the way. He has to complete the contract. The futures contract has to be executed. An options contract can be abandoned. That is the major difference between a futures contract and an options contract. A futures contract involves a process called marking to the market or mark to market, which means money actually moves between accounts each day at the end of the trading, whether the price goes up or the price goes down. But you have to make an end of the day adjustment in your accounting procedures. A forward contract is functionally similar to the futures contract. However, there is no end of the day marking to the market. You do not evaluate a forward contract on a daily basis. So there is no marking to the market, and forward contracts are not marketable. You have a forwards contract, you're stuck with the contract. In a futures, you've got the option of maneuvering a buying and selling position again and again as and when you desire so. A forwards contract then would be an agreement to buy or sell an asset at a certain future time for a certain price, but is traded over the counter. Forwards are not traded on the exchange. Are an agreement between one person and another person, or one institution and another institution, but have certain credit risks involved in it. So I would, put my vote towards a futures market instead of a forwards market, because more reliable, more clarity, more reliability, no credit risk in the futures contract. But this is how you keep improving financial products, by coming up with much better products. So if we were to look at forwards and futures, forwards then would be private agreement between two people. Futures would then be an exchange-traded contract. In a forwards, you would have a non-standard contract. In a futures, you would have a standardized contract. In forwards, you would be using usually one specified delivery date. In futures, you can have a range of future delivery dates. Forwards are settled at the end of the contract. Futures are settled mark to market on a daily basis. Forwards are a delivery or final cash settlement, usually occurring in a futures contract, usually closed out prior to maturity. Forwards at maturity, futures prior to maturity is possible. In forwards, you have some sort of a credit risk. In futures, there's virtually no credit risk. This was important for me to explain to you the difference between a forward and futures, and how you'd be able to understand futures probably being a much better product than a forwards product. So once we've understood that forwards and futures have certain similarities but more differentiation, it'll be good for us to be understanding what sort of a product we must go into. Obviously, anything to do with responsibility has to be looked into, and that then would be the futures contract, because that's exchange traded. If we were to look at futures and options, we would understand the futures do not expire unexercised. The contract obligation may be satisfied by making an offsetting trade. You can switch over position, but you have to complete the trade. then you would look at different ways people use the futures market or the derivatives market. Maybe you would have hedgers or speculators or arbitrageurs. It would all depend on the categories of market players. So hedgers use futures to reduce price risk. Speculators assume risk. Arbitrageurs take advantage of price differences in different exchanges. Options, once again, get a hold of the word options, gives the owner of the contract a right, but not an obligation to buy or sell in the future. Traded both at exchanges and over-the-counter markets, but you can abandon an options contract whenever you want to. You don't have to go all the way and complete the contract, which is the major difference between a futures contract and an options contract. These words are actually self-explanatory if you look at them even at the standard English dictionary. Instead of a financial dictionary, you look at the word futures and you'll understand it's all about futures, times to come. And if you look at the word option, tell you about alternatives and options, not an obligation. So options, choices would be the word that you'll understand, will be then used in the financial world then. So an option is the right to either buy or sell something at a set price within a set period of time. The right to buy would then be called a call option. Now this is where things start getting a little bit confusing, because buying is going long, but in the options market you call it a call option. So buying is a call option. The right to sell would then be a put option. I did always realize that English is a difficult language, but this is becoming even more complex in the financial English language. So buying is call and selling is put. Another product that we needed to talk about was the swaps. And once again, it's standard English word for exchange. Exchanging, swapping positions. The swap is an agreement to exchange cash flows at a specified future time at certain specific rules defined for swapping. The swaps would be arrangements in which one party trades something with another party. You exchange things, you swap things. You've been doing that in childhood as well. You swap things, exchange goods, exchange presents. You swap financial positions. The swap market actually is a huge market. It's trillions of dollars worth of market. You keep swapping your position. The swappings work in different ways. The switching works in different ways. The exchange works in different ways. You could even exchange or swap interest rates. You could swap foreign exchange. You could swap commodities. If we were to talk about swapping interest rates, we would understand that we would look at maybe swapping a fixed interest rate. A firm pays a fixed interest rate on a sum of money and receives from another firm a floating interest rate on the same sum. So you are swapping a fixed interest rate with a floating interest rate. This then would be able to make you understand swapping as in exchanging the quality of the product or the synergies of the financial product. You could then also think about swapping currencies, which would then be called a foreign currency swap. The foreign currency swap would then be two firms initially trading one currency for another. Maybe a dollar with a euro, or a euro with a pound sterling, or a pound sterling with an American dollar. The variation is immense. So once you bought or sold one, you subsequently, the two firms exchange interest payments, one based on a foreign interest rate, the other in the local currency, say the US interest rate. So finally, the two firms then re-exchange the two currencies. Two countries may be involved, two products of two countries, two interest rates of two currencies, two foreign currencies of two countries then are involved and exchanged and re-exchanged to settle the product. Swapping, options, forwards, futures are wonderful financial engineering products. And people now have a range of different products to use for their financial advantages instead of just the run-of-the-mill commodities and the stock market. There are certain characteristics with all these products, certain characteristics with the derivatives market, certain characteristics of futures and options. So both options and futures contracts exist on a wide variety of assets. Since the word derivative is there, you can have a derivative of anything worth the while. You only have to have an underlying asset available to you so that you can use it for a derivative. The options trade on individual stocks, on market indices, on metals, on interest rates, future contract, anything. You name it and they've got it on the options market. The trick is that there has to be an underlying asset for the options to be derived from, the option to be traded upon. The futures contracts trade on products such as wheat, live animals like cattle, sheep, gold, silver, platinum, heating oil, cooking oil, foreign currency, US Treasury bonds, stock market indices. There are a wide variety of things that you could have a futures contract. They're all deliverables. But once again, you don't necessarily have to go to the time of maturity to understand that a future contract has to be finished with the final product. You may just enter into a futures contract and get out when you have made a profit on the futures once you've rolled over your position from buying into selling to complete the contract, or vice versa. Also, there are other characteristics which are associated with the derivatives market. I just talked about the derivatives, which is based on an underlying asset. Now, the underlying asset is that which you have the right to buy or sell with options, or to buy or deliver with futures. Focus on the word right to buy or sell in the options, or to buy or deliver in the futures market, which means you have to finalize the contract in a futures market, not so in the options market. This might sound a little bit repetitive to you, but it has to be repetitive because you must get this into your ears and into your minds that this is something new that we are talking about. Derivatives then would be understood more. So you don't have to be scared when somebody asks you about derivatives. More characteristics about the derivatives is that you have listed derivatives traded on an organized exchange, such as the world's biggest option exchange, the Chicago Board of Options Exchange. CBOE then would be the code for it, the Chicago Board Options Exchange, or the CBT, which stands for Chicago Board of Trade. These are one of the biggest exchanges as far as options concerned. We also have over-the-counter derivatives. These are customized, tailored products that trade off the exchange between individuals or between two parties or two institutions. Listed derivatives then would have specified, fixed characteristics. OTC derivatives would have a tailor-made, designed feature for two parties to agree upon. We've talked a lot about product characteristics, different variations of the derivatives, and how they are used to their abilities, the people's abilities, and how they can use the derivatives to their advantage. One last word is that options are securities and are regulated. These are regulated by the Security and Exchange Commission. So the fear factor of a credit risk is probably much less when we understand that these are monitored by somebody, that there is a watchdog, that there is somebody responsible for looking at whatever is being traded on the exchanges. So futures contracts are regulated by the Commodities Futures Trading Commission. The CFTC is the word for Commodity Futures Trading Commission. The options are regulated by the Securities Exchange Commission, which is the SEC. So options have their own watchdogs, futures have their own watchdogs. So some key points about the futures. Once again, is the mark-to-market, meaning they are settled daily. Closing out a futures position involves entering into an offsetting trade, and most of the contracts are closed out before they actually mature. Now you can do a number of futures trade before maturity end, and you can do dozens of buying future contracts and give dozens of selling futures contracts. As and when you get a profit, you can use it to close the trade much before the maturity date. Let's assume you have a 1 month maturity date for the futures contract. You might end up offsetting the trade the same day you bought in the futures market. If you're long in the futures market, you plan to stick around till the end of the month, you got a good opportunity. You closed the trade with an offsetting trade, so you sold it the same day. This happens very normally, can happen a dozen times before maturity comes. So most contracts are actually settled out before the contract actually expires. Now the features of these future contracts are they're available once again in a large variety of underlying assets. Not to mention that they are exchange traded, which means virtually no credit risk. Specifications are defined. Underlying can be anything from a barrel of oil, crude oil, or short-term interest rates. It can be anything. The amount in units are then specified of the underlying asset. There's going to be a delivery month. Which month are you going to complete your futures contract? There's going to be last trading day. Sometimes here we have Friday being the last trading day of the current month, being the last trading day. We can then also talk about the grade of deliverables, whether it's a 24 karat gold or a 22 karat gold. Is it crude Brent oil or any other kind of oil? We can talk about types of settlements, whether it's going to be cash settled or physical settled. We can also determine the currency in which the futures contract is being quoted. So the variations are large. You have to have specific variations for the futures contract, but one thing is significant: it is settled daily. Settled daily to find out what the profit has been, to find out what the loss has been. So you will have futures contract putting in money into your account or taking out money from your account because it's settled daily, although maturity date is by the end of the month, with trading day probably being the last Friday like here locally. But procedures include finding out what you earned today or what you've lost today. Mark to market is done on a daily basis on the futures contract. If you were to be talking about deliveries in futures contract, it is a possibility. But if a futures contract is not closed out before maturity, it is usually settled by delivering the asset. Also, we must understand when there are alternatives about what is delivered, where it is delivered, and when it is delivered, the party with the short position chooses. If nothing has been defined about the grades, about the times, about the delivery methodologies, then that will lie with the seller of the futures contract, and he can have alternatives, best possible alternatives to oblige the buyer of the futures contract, provided the maturity has ended and the contract has not been completed by offsetting a trade. So then the seller will have the best possible choices, best reasonable, acceptable choices about what is being delivered, when it's being delivered, and where it's being delivered. So deliveries can take place, but generally speaking, most futures contracts do not end in deliveries and are more so settled by an offsetting trade in the opposite direction. If you bought, you sell. If you sold, you cover up or buy it, and you offset the trade so that the contract is completed, because the word contract will mean something only if the contract is completed. So deliveries generally do not happen in the futures, but we do understand that they can possibly take place. Now, one thing that you must understand about futures is that it's never done on cash, it's done on a margin. What is a margin then? This is going to add more to your vocabulary. Margin is a word that is definitely going to be around in the financial circle, would then be a cash or marketable security deposited by an investor with his or her broker. A collateral as a cash or a commodity or a product, a marketable product that is used as a margin for whatever businesses are to be done by the investor. The balance in the margin account is adjusted to reflect daily settlements. And that is why we have a mark-to-market procedure, because we have to look at the accounting procedures, see what is there in the gentleman's account or the lady's account, and see whether more trades can be done on those accounts, which would then be balanced out with the margin initially deposited, or will be added daily to the margin or subtracted daily from that margin. So margins minimize the possibility of a loss through a default on a contract. Something like a goodwill, earnest money, a down payment, that this is the limits of your loss liabilities. Well, not actually the limits of your loss, but something for the broker to be comfortable with, that this is the amount available by an XYZ or an ABC investor, and he can then trade on that account. Of course, I mean, the investor will be using the broker's facilities to trade on his own, but then there will be margin available on which to dwell upon, or which to make new investment theories, make new investment positions of buying or selling. These are important because you must understand these are the different ways you use the futures contracts. We talked about deliveries. We just talked about margins. Now, we must understand the futures markets also. We must understand that there is a spot market. There is also a cash market. So you'll have spot markets and you'll have cash markets in which price refers to the items available for immediate delivery. If we were talking about the forwards market, we would understand this price would refer to the item available for delayed delivery. Price now, delivery later. In the futures, you set the future contract size, the future delivery date, the future conditions for delivery, and settle in the future. Just a quick revision. Spot and cash would be immediate. Forwards would be pay now, get delivered later, or settle the price now and make the decisions later on a particular date. And in the futures, you settle everything now and decide about the deliveries before maturity, at the time of maturity, or offset the trade before maturity. Stock market generally works in these three variations, but generally so more in the regular market or the cash market or the spot market and the futures market. Locally, we have a regular market and a futures market also. The futures market characteristic then would be a centralized marketplace. Since it's exchange traded, the exchange then would be a central figure place where you'd come buy and sell, whether through the open outcry method or through electronic trading. This place then allows investors to meet or not knowing each other but trade with each other on one common platform. The performance is guaranteed by the clearinghouse, and like all mature exchanges, we too have the National Clearinghouse, which takes responsibility for the cashes and the products to be settled. There is a valuable economic function of the futures market. The valuable economic function would be that hedgers would use it, speculators would use it, arbitrageurs would use it, but hedgers shift price risk to speculators. We'll talk about hedging, speculating, and arbitraging later. There is also price discovery that conveys information about the markets. There'll be different ways that people will use the futures market to their advantage. There'll be hedgers that I'll be talking about. There'll be speculators that I shall talk about as well, and about arbitrages as well. It's quite interesting though. But for now, you must understand the future market gives you the facilities, it gives you the privileges of using the futures market in a variety of ways, provided you understand the futures markets and how you can buy and sell the futures contract through the exchange or on the exchange. A little bit about commodities as well, and products, agricultural products, metals, energy-related products can be dealt on the commodities market. We haven't discussed the commodities market as yet. Maybe we will if time allows. We have a commodities market here as well. So we have a good, balanced, diversified financial sector here in our country. The financials in the futures market are, you can talk about foreign currencies as well as debt and equity instruments. Foreign exchange markets or foreign futures market is understood as an increasing number shows that the move towards globalization, trading without frontiers, trading on e-commerce or trading on the internet has made boundless, immense, infinite varieties of products for you to trade in, and infinite number of ways that you can, satisfy your need for products. Markets are quite competitive with the US environment. The reason that we have to give reference to the United States is that it is the financial world, the capital. Everything is probably being benchmarked with the performance of the United States financial markets, products available there, characteristics of the products available there, and more new things are coming up in the futures market there in the United States. So we can maybe be talking about future contracts. You could buy, sitting right here, you could buy maybe euros, yens, pound sterlings, US dollars, Canadian dollars. The range is immense. The horizon is spectacular. You can look at what you want to do, provided you have the facilities to do so. And of course, the funds available there should be with you as well. Now, futures contract, a little bit in detail, is an obligation once again to buy or sell a fixed amount of product, a fixed amount of an asset on a specified future date at a price set today, now. You decide this now, set the price now, pay later, settle later, deliver later, or offset later at a predetermined month, at the date of maturity, or maybe prior to the maturity date. D for derivatives, D for dread, not so. Futures is here to stay. Futures will make you more successful in a much quicker way once you understand the futures market. Trading in futures would mean commitment has been made between a buyer and a seller. Obviously, if you have a buyer on the other side or a seller on the, then only you'll be able to have a contract. Positions are offset by making an opposite contract in the same commodity. You bought and you'll then sell. You sold and then you'll cover. You'll offset the trade, and then only the contract will be completed. The Commodity Futures Trading Commission regulates the trading of the futures market. I mentioned it before, I'm saying it again, that futures market is regulated. Futures market is safe. As safe as driving a car, of course, with the seat belt on, or driving a motorbike, of course, with the helmet on. I'm not denying the fact that there are risks not involved. Yes, there are risks. You cannot avoid risks, but who's saying you can't manage them? You can manage risk. That's the beauty of this subject, for you to be able to understand how to manage risk and make the most of the financial products. The futures exchange would then be where future contracts are traded. Voluntary non-profit associations of memberships are there, and this would be an organized marketplace where there are established rules and established rules that govern the conduct. Good governance, corporate governance, transparency are the words associated by investors with good organized exchanges. The futures exchanges are funded by dues and fees for services rendered to the members of the exchange or to the members of the brokers in the futures market, and that is on which the exchange thrives upon. Fees and dues for services rendered by the exchange. We have members trade for themselves, members trade for others. But it's always good to know about members who don't trade themselves but just offer services for investors to trade in the exchange. Once the brokers or members trade for themselves as well, makes it more speculative for investors, because it would be a good idea just to be dwelling upon commissions. If you're trading yourself as a broker, would up the stakes, make you more risky as a member of the exchange, because then that would make you more vulnerable to all the volatilities and variabilities of price changes in the stock market. Remember, these stock exchanges here in our country are all not-for-profit organizations. They just take in dues from the listed companies and service charges from the brokers to manage the exchange for the services being rendered or provide for them for their investors to work at the exchange, trade at the exchange, buy at the exchange, sell at the exchange. A little word about the clearinghouse as well. A clearinghouse an organization, a corporation set up in a separate form as a separate entity, but is obviously associated with all the exchanges. Of course, the exchange came first, the clearinghouse came later. So we have no problem about whether the egg came first or the chicken came first. The exchanges came first, the clearinghouse came later, but none of the two can exist without each other now. Since we do not have an open outcry method, we're dwelling upon the services of each other to make this a better place to trade. The clearinghouse are associated with exchanges. Exchange members must be members or pay a member for these services. So you have to be members of the stock exchange. You also have to be members of the clearinghouse to facilitate the trades. The buyers and sellers settle with the clearinghouse, not with each other. So you have a third party in between to settle your trades again. Like you have a brokerage house to execute your buying and selling orders. So a clearinghouse helps facilitate and make an orderly market. And what it also does is it keeps track of all the obligations that have to be met, because since it's the clearinghouse, it's responsible for all deliveries and all payments to be made, which makes the financial capital market a much better place to work in, a much better place to invest in, because things are so organized now. Things are so transparent now. Things are so electronic now. Things are now so fast now that things couldn't be much better now. And that is why there has been a phenomenal rise in the prices of products, of futures, of the underlying assets, because things are getting smoother to trade at. If you were to look at the mechanics of trading, we would understand through open outcry methods, sellers and buyers agree to make a contract and agree on a certain price and agree on a certain delivery date, so that you can decide when you want to buy or sell, but you determine it now. Short position sellers, in other words, sellers or short sellers commit a trade to deliver an item on the maturity of the contract. On the other hand, a long position holder or a buyer commits a trader that he will make up a payment for the product. So he's buying a product, so he'll make a payment. Somebody who's selling the product will obviously deliver the product. Like options, futures trading is also a zero-sum game, because somebody is making a delivery, somebody is making a payment, somebody is making a profit, another is making a loss, somebody is making a profit more than another person. It's going to be shifting of funds, it's going to be shifting of products from one person to another person. Is another way how the market works. It is shifting of commodities or products from one person to another person, and of monies from one person to another person. So this is how you understand the futures market or the options market as well. A little bit ahead, if we can understand once again how contracts are settled. We talked that contracts can be settled in two ways. One, through a delivery. Two, through an offsetting trade, in which there is a liquidation of the contract prior to the maturity date. So you can offset, which would mean liquidation of a prior position with an offsetting transaction. Just 2% people actually go in for the delivery methodology. 98% people offset the trade, which means cash settled, not with deliverables. It is more towards profits and losses in the futures market than to make a delivery and a payment. So each exchange establishes price fluctuation limits on contracts. certain circuit breakers or benchmarks or ceilings or floors on which there cannot be a lot of volatility in the product price. So each exchange then would have establishing a price fluctuation limit on each contract, just the way we have this on the underlying assets as well. Remember, in the futures market, there is no restriction on short selling. There is restriction on short selling in the regulars market or the spot market or the cash market, but no restriction on the futures market. And this is an important element that we must understand about the futures market and the regular market. So we are to understand the futures market as something that can be talked about as short selling as well, a way of using the market in both directions. Selling what you own or selling something that you do not own. So you buy first, sell later, or you sell first, buy later. Either way, you can use the market in the futures, not in the regular market. We talked about margins, a little bit about margins once again, the futures margin. And I mentioned it would then be the earnest money that is deposited both by a buyer and a seller with a broker to ensure performance of obligations, ensure that obligations shall be met. That is what a margin is called. Not 100% of the money involved, maybe a 20 to 30% margin then would be sufficient for the broker to feel satisfied that obligations shall be met. Remember, this is not an amount that would be borrowed from the broker. What you're borrowing from the broker is something extra, other than what you've actually put in an earnest money, because he's going to provide you the rest of the margin. So earnest money is not to be confused as money borrowed from the broker, but something that you on your own shall have to provide to the broker. Each clearinghouse sets requirements. Brokerage houses can require higher margins, lower margins, or no margin at all, depending on the credibility of an investor or an institution. The credibility, how good one has been in meeting up obligations. Initial margin usually less than 10% in some cases. Initial margin usually locally around 30% is sounded fair to do further business in the product. So 10%, 20%, 30%, 50%, or 100% would then be the margin required for somebody to trade. Obviously, if you were walking in to a broker's house, nobody would trust you with a margin, so then you'd have to come up with a 100% margin. But if you've developed a sort of a comfort level with the broker, you would understand that that would be good enough for him to reduce the limits to an extent where you would be able to get maybe a 10% margin or a 20% margin for the businesses that you do. So there'll be talks about margin calls then. And you need to come up with more margin when prices go up against the investor's position. Or you'll need to have put in more monies or deposit more marketable securities so that you can have margins, because positions are closed on a daily basis. So this was about derivatives market. It was an investor-friendly product, which is now considered a good future way of investing. We'll talk about these things in detail in the next lectures to come. Thank you very much.